You know, when you picture the ultimate untouchable investor right now in July 2026, I feel like the image that usually comes to mind is someone glued to a terminal.
Oh, yeah, like surrounded by 6 monitors.
Right. Someone trading in microseconds, using quantum algorithms, just desperately trying to beat the machine at its own game, especially in a market that feels this incredibly top-heavy.
Yeah, it's a very chaotic environment right now.
It really is. But what if I told you the smartest, most ruthlessly effective players out there aren't doing that at all? What if they are simply, I don't know, sitting back, pouring a cup of coffee, and literally manufacturing yield out of thin air just by being patient?
I mean, it sounds like a contradiction, right? In a market where everything is moving at light speed and valuations feel so stretched, patience doesn't usually pay the bills.
Yeah, most people think you have to be aggressively active to generate returns today.
Exactly. But there is a very specific structural way to monetize that waiting period.
And that is our mission for you today on this deep dive. We are looking at a stack of specialized financial research and market data to decode a strategy used by institutional value investors. It's called the cash secured put.
A very powerful tool if you understand it.
Yeah, so we're going to explore how these investors navigate market exuberance, how they basically enforce the discipline of buying low, and how they get paid a cash yield just to act as the insurance company for everyone else's panic.
It's a fascinating shift in perspective.
It really is. Now, before we jump into the mechanics of how this all actually works, I need to share a quick piece of mandatory housekeeping with you. To access more advanced researches, applications, and our latest personal deep value agents, welcome to explore and join deepvalues.ai app. Track total market temperature, welcome to search and download iOS app Buffett Indicator from Apple App Store or Bubble Watch from Google Play. Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for research and entertainment purposes only and does not constitute any investment or financial advice. Conduct your own due diligence before making investment financial decisions. Don't forget to like this video. Much appreciated.
Okay, that's out of the way.
Yeah, okay, let's unpack this. Because usually when people hear the words options trading or derivatives, they immediately think of reckless speculation.
Right, they think of day traders.
Exactly, gambling, essentially.
Which is, a fair assumption. Derivatives are often heavily marketed to the broader public as lottery tickets. But for a disciplined value investor, a put option isn't a gamble at all. It is fundamentally a specialized insurance contract.
Okay, break that down for me.
Sure. So if you buy a put option, you are paying an upfront cash premium for the right, but entirely without the obligation to sell a specific number of shares at a predetermined price.
Which we call the strike price, right?
Right, the struck price. And you have the right to sell at that price before a certain expiration date.
So as a buyer, I'm just purchasing downside protection. Like I'm terrified a stock is going to crash. So I pay someone a fee to guarantee they will buy it from me at a set price, no matter how bad things get.
Precisely. But this entire strategy we're looking at today revolves around being on the other side of that transaction.
The seller.
Yes, being the seller or the writer of the put option. When you sell that put, you are the one collecting that upfront cash premium from the terrified buyer.
So I get the cash today.
You get the cash today. But in exchange for taking their cash, you assume a strict fiduciary obligation to buy those shares at the strike price if the buyer chooses to exercise the contract.
So it's kind of like a real estate transaction. It's like getting paid a massive, non-refundable cash deposit today just to promise you'll buy a house at a 10% discount next month.
That is a perfect way to look at it.
Because whether the market tanks and you actually buy the house or the market goes up and the deal falls through, you still get to keep that non-refundable deposit.
That analogy hits the nail on the head. And the crucial modifier we really have to focus on here is cash secured.
Right, right. Because you can't just make promises you can't keep.
Exactly. Institutional value managers aren't just writing these promises into the void, hoping the market doesn't call their bluff. They maintain sufficient, highly liquid cash in their brokerage accounts to buy those shares outright if they are assigned.
Setting aside the cash completely eliminates the systemic risk, doesn't it?
It does. It eliminates what we call naked option writing. That's where you promise to buy something you can't actually afford, which is how people blow up their portfolio.
Yeah. Nobody wants that. And there's a very simple, elegant formula at the heart of this that we pulled from our source data. Your effective cost basis equals the strike price minus the premium collected.
That's the magic formula.
Meaning the money you get paid up front directly lowers your actual purchase price if you end up having to buy the stock.
Right. By using that formula, We transform the put option from a speculative bet into essentially a yield-bearing limit order.
A yield-bearing limit order. I like that.
Think about a traditional investor. If you want to buy a fundamentally sound company, but you think the current price is too high, you place a standard limit order below the market price and you wait.
And wait. And wait.
Right, and that limit order pays you absolutely zero return while you just sit in cash waiting for a market correction. The cash-secured put revolutionizes that waiting period.
Because you're getting paid.
You are generating a real cash yield on the capital sitting in your account while you wait for your target price to hit.
And if you're listening and you think this is some, I don't know, new age derivative trick cooked up by a day trader, it's not.
Not at all.
The ultimate proof of its value investing pedigree comes from the oracle himself, Warren Buffett.
Oh, the 1993 Coca-Cola trade. Classic.
Yeah. Let's go back to April 1993 to see how this actually looks in practice. So Buffett already owns about 93.5 million shares of Coca-Cola in the Berkshire Hathaway portfolio.
He's already heavily invested.
Right. And the stock is currently trading in the open market at around $39 a share. Buffett likes the company, obviously, but he does his intrinsic value calculations and decides $39 is just a bit too high for him to buy more. He wants a wider margin of safety.
His internal modeling dictated that $35 per share was the true bargain price. That $35 mark was his absolute line in the sand.
So instead of just setting a boring limit order at 35 and earning practically nothing on his billions in cash, he turns to the options market.
And operating at an incredible scale, Buffett writes 50,000 out-of-the-money put contracts.
And just for anyone unfamiliar with the terminology, out of the money just means the strike price he chose, $35, was below the current market price of $39.
Right, it's out of the profitable zone for the buyer right now. Because each option contract represents 100 shares of the underlying stock, Buffett is making a legally binding promise to buy 5 million shares of Coca-Cola.
At a strict $35 strike price.
Exactly, with the contracts expiring in December of that year.
And for taking on that downside obligation, for acting as the insurance company for the market's anxiety, he demanded a premium of $1.50 per share.
So doing the math on that, 5 million shares times $1.50.
That is $7.5 million in pure cash premium deposited directly into Berkshire Hathaway's accounts on day one.
It's brilliant.
It really is, because look at the two possible outcomes here. Outcome one, December rolls around and Coca-Cola is still trading above 35.
The buyer has no reason to sell Buffett shares at 35 when they could sell them on the open market for more.
So the options just expire worthless, and Buffett simply keeps the $7.5 million in cash as pure profit. He generated a massive yield on a block of stock he never even had to buy.
And outcome two is equally favorable.
Yeah.
Let's say the broader market corrects and Coca-Cola drops down to $32 a share.
Okay, so it crashes.
Right. Now, the buyer of that put option exercises it, forcing Buffett to buy those 5 million shares at his promised $35. But remember our formula.
The effective cost basis.
Yes. His effective cost basis isn't 35. Because he already collected $1.50 per share up front, his true entry price drops to $33.50 per share.
So he got paid $7.5 million in cash to do exactly what he already wanted to do anyway, buy a monopolistic business at a pre-calculated discount.
It completely flips the script on how we view derivatives. You aren't gambling, you are being paid to enforce your own strict valuation rules.
But to effectively apply Buffett's 1993 logic to our current reality, right now in July 2026, we really have to understand the underlying mathematical engine that actually prices these option premiums.
We need to look at the Greeks.
Right, the Greeks. And I know this is where people usually start tuning out, but stick with us, because understanding this is what gives you the edge.
It's crucial.
There are three main variables moving under the hood that we need to look at: delta, theta, and vega. Let's break these down into plain English.
We can think of delta as essentially your probability dial.
Okay, probability.
It tells you the statistical likelihood that your option will end up in the money, meaning you'll actually be assigned the shares.
Got it.
So if you write a put option with a 0.10 delta, you're taking a highly conservative approach. The math implies there's roughly a 10% chance you'll have to buy the stock.
So you'll sleep soundly at night, but because the risk is so low, you'll collect a very small upfront premium.
Exactly. Conversely, if you push the dial up to a 0.30 delta, you get a much higher immediate cash yield, but you are accepting a 30% chance you're taking delivery of those shares.
Okay, so delta is probability. Then there's theta, which measures time decay. And I was looking at this in the source material and thinking, wait, if theta means the asset is actively decaying and losing value every single day, Why is that a good thing for us?
It seems backwards at first.
Right. But then I realized, oh, because we sold it. We don't own the option, we sold the option. We want its value to decay to absolute zero.
That's the light bulb moment.
Here's where it gets really interesting. Time itself is actually padding our profit.
That is the core structural advantage of being an option seller. Options are designed with finite, decaying lifespans.
Yeah.
For the put seller, theta acts as a daily accrual of profit.
So just waiting makes you money.
The simple passage of time literally erodes the buyer's premium away. You can retain that value and buy the contract back for pennies on the dollar later, even if the underlying stock price remains entirely stagnant.
You are essentially manufacturing a daily dividend from a stock that isn't even moving.
It's incredibly powerful. And finally, we have Vega. This measures the option's sensitivity to implied volatility.
Or, in simpler terms, it measures human fear.
Yes, human fear. When panic enters the broader market or a company has a scary earnings report coming up, uncertainty spikes. And when uncertainty spikes, implied volatility spikes.
And this fear leads to a psychological phenomenon known in the options market as volatility skew, right?
Exactly. Human beings are evolutionarily wired to be terrified of sudden catastrophic losses, much more so than they are excited by sudden steady gains.
We hate losing more than we like winning.
Exactly. And because of this deeply ingrained fear, out-of-the-money puts are structurally priced much higher than equidistant calls. The market consistently overpays for downside protection.
So as a value investor, you step in during these localized panics. You act as a highly paid insurance company.
Yes. Then, when the earnings report comes out or the panic subsides and the market digests the news, you experience what we call a volatility crush.
The balloon just pops. The uncertainty is gone, so the fear premium vanishes.
And the option's value instantly deflates, delivering outsized, rapid profits to you as the seller.
The intrinsic value of the business didn't change at all, but the psychological premium just evaporated.
It's a behavioral arbitrage, really.
So if we take these mechanics, the Greeks, the volatility crush, the Buffett blueprint, how do we apply them to the market we are looking at right now in July 2026?
Well, you have to look at where the capital is concentrated.
Right, because the S&P 500 is wildly top-heavy right now. We're looking at a landscape where just the top 10 companies make up roughly 38% of the entire index.
It's unprecedented concentration.
You've got NVIDIA sitting at a $5.11 trillion market cap. Apple is at $4.63 trillion. Microsoft at $2.86 trillion.
And these megacaps are where the smartest institutional capital deploys this strategy. They have massive daily trading volume, penny-tight bid-ask spreads in their options chains, and essentially zero statistical risk of total corporate bankruptcy tomorrow.
They are the perfect structurally sound targets.
They really are, and the execution changes depending on the personality of the stock.
Okay, like take Apple, for example. It's trading at $315.32. It's got massive cash reserves, huge share buyback programs. It's basically a financial fortress.
Because Apple is so incredibly stable, its implied volatility is generally suppressed. It doesn't have violent, unpredictable price swings very often.
So you're not getting those crazy high premiums.
Right. So a value investor might use Apple as a synthetic fixed income substitute. Let's say you identify a historical technical support level around $295. You can continuously sell $295 strike puts every month.
And because it's so safe, the premium might only yield, 1% to 1.5% a month.
Around there, yes. But assuming you aren't assigned, you are generating a highly consistent bond-like yield on your cash that utterly crushes standard money market rates with extremely low stress.
But if you want to juice that premium, you have to look at a company like Microsoft, right? Trading at $385.10.
Yes. Microsoft is a different beast right now.
It's got that enterprise software stability, sure, but it's aggressively pushing AI monetization, which injects periodic bursts of volatility into the stock. And our sources model Microsoft's intrinsic margin of safety value down at $360.
So looking at the options chain, an investor could sell a 30-day put option at that $360 strike.
Let's run the actual math on that.
Sure. So the investor holds $36,000 in liquid cash and escrow per contract. For taking on that obligation to buy 100 shares at $360, they collect a $500 cash premium today.
And if Microsoft stays anywhere above $360 over those 30 days,
they earn a 1.38% return on that escrowed capital in just 1 month, which annualizes out to over 16%.
that's incredible. And if the stock drops to $350 and they get assigned,
They use the $36,000 to buy the shares, but their effective cost basis is mitigated down to $355 because of the premium they collected.
It's remarkably methodical.
Hmm.
But, if we follow this logic, it makes me wonder what happens when the strategy is pushed to its absolute limits.
Meaning what exactly?
Well, we've looked at stable fortresses like Apple and Microsoft. But what happens when you apply this exact same cash-secured put strategy to the most chaotic hyper-growth anomaly in the 2026 market?
Ah, you're talking about SpaceX.
I am absolutely talking about SpaceX. Let's talk about the 800-pound gorilla that just went public on June 12, 2026. Largest IPO in U.S. history, raising $85.7 billion.
The scale of the hype is unprecedented. By mid-July, it's trading at $145.30 with a $1.90 trillion market cap.
That instantly makes it the seventh largest company globally.
It's staggering.
But as value investors, we have to look under the hood. I look at their 2025 financials, $18.7 billion in revenue, mostly driven by Starlink, which has incredible 63% margin.
Great margins, yes.
But they still posted a GAAP net loss of $4.9 billion. And then you have to factor in the xAI merger in February 2026.
Right. They executed a $1.25 trillion all-stock merger to absorb xAI.
Which resulted in a massive $14 billion cash burn just to build out AI infrastructure.
Yeah.
So we are looking at a $1.9 trillion valuation on $18 billion in revenue. That is a 73x price-to-sales multiple.
It's a very high multiple.
Just for context, Meta is trading at 16x.
Hmm.
As a value investor looking at a 73x multiple, shouldn't we be running away screaming from this?
A traditional value investor would never buy that stock at $145. They clearly recognize the structural overvaluation and the intense retail fervor driving the price.
Yeah.
But they also recognize that Starlink is a cash-printing monopoly with a massive moat. So suppose our value investor strips away all the AI hype and models SpaceX is true, intrinsic fair value at $1.2 trillion.
Which breaks down to roughly $90 a share.
Correct. So $90 is their fundamental margin of safety. Now, because of all that insane retail hype and the recent IPO, SpaceX's implied volatility is routinely sitting in the 80th percentile.
Wow.
The market is absolutely willing to pay astronomical cash premiums for downside protection. So instead of sitting in cash for years waiting for a crash to $90, the value investor sells a 60 to 90-day put at that $90 strike.
And because the implied volatility is so incredibly high, they collect a massive $10 premium per share upfront.
Exactly.
Wow. So if SpaceX just stays in the stratosphere anywhere above $90, you pocket that massive $10 premium, which is a huge yield on your cash. But if the hype bubble eventually bursts and it crashes down to, say, $85, you are signed at $90. But minus that $10 premium, your true cost basis is $80.
Right. You just acquired a monopolistic aerospace and AI asset at a severe discount to its IPO price.
That's wild.
And there's a unique structural dynamic in 2026 making this specific trade even more lucrative. The broader financial market has created leveraged single-stock ETFs around SpaceX.
Like the SPCU, which is 2x long, and the SSPC, which is 2x short.
Yes, which means you have algorithms just aggressively trading against each other all day long to maintain those leverage targets. These leverage funds have to constantly buy and sell underlying swap agreements at the end of every single trading day to rebalance their exposures.
Oh, wow. So this constant forced mechanical trading creates what they call synthetic volatility.
Precisely.
Yeah.
It artificially exaggerates the daily price action of SpaceX, swinging the stock wildly. The options market sees these intraday swings and keeps those implied volatility premiums chronically elevated.
So the put seller is heavily rewarded by this leveraged ecosystem, collecting massive premiums without the intrinsic value of the actual aerospace business changing at all.
You're just monetizing the machine's chaos.
Now, if you're listening to this and thinking, well, this sounds way too easy, what's the catch? You're right to ask. We have to look at the downside. Because if you find a great company, pick your dream discount price, and get paid handsomely by synthetic volatility to wait for it.
Yeah.
What happens if the bottom falls out of the entire global market all at once?
The Black Swan event.
Yeah. Like if I'm writing puts on Apple, Microsoft, and SpaceX all at the same time, and some massive geopolitical crisis hits, don't I just run out of cash?
You've hit on the most critical danger of this strategy: opportunity cost and over-leverage. Remember, the capital required to secure these puts is locked in escrow in your brokerage account.
Right.
If a black swan event causes a deeply correlated drawdown across all equity sectors, every single put you wrote across all those companies could plunge in the money at the exact same time.
So I'd be legally forced to buy everything at once.
You'd be fully invested in equities at the exact moment the market is crashing, fully exhausting all of your cash reserves. You'd have absolutely zero liquidity left to buy other deeply discounted assets that have emerged in the panic. That is why strict position sizing is paramount. You cannot deploy 100% of your capital into put writing, no matter how attractive the premiums look.
Okay, that makes sense. But it's not just a macro market crash we have to worry about, right?
Mm.
What if the underlying company is just fundamentally falling apart? We've talked about selling puts on volatile stocks where the volatility is driven by hype, like SpaceX. But what if the high volatility is driven by actual corporate deterioration?
That is known as the value trap. And the premier cautionary tale for this in July 2026 is Intel.
Intel. Mid-July 2026, Intel is trading in this volatile, choppy range between $107 and $120. They're dealing with split rumors. They're demonstrably losing the GPU war to NVIDIA and AMD.
That's a rough spot for them.
But an undisciplined investor might look at Intel's high implied volatility and think, hey, selling a $105 put is a great deep value play. Look at that premium.
But Intel had established a terrifying pattern of massive, unrecoverable gap-down moves. On June 5th alone, it dapped down and closed down 6.8% for the session.
Brutal.
If you sell a $105 put on Intel just to get a juicy premium, and they release terrible news causing the stock to gap down to $90, your $105 put is now deeply in the money.
Meaning the buyer is absolutely going to force you to buy it at 105 because the open market price is only 90.
Yes. You are legally forced to buy a failing business at a massive premium to its current value.
And the upfront premium you collected won't even come close to covering that $15 per share loss.
Not even close.
So to avoid getting stuck holding the bag on a declining asset, how do the professionals manage this life cycle? Because if you do get assigned on a good company, your capital is now trapped in the stock. How do you get it back out?
Professionals manage this using a continuous closed-loop options life cycle known as the wheel.
The wheel. Let's break this down. The cycle starts exactly where we've been discussing, right? You sell an out-of-the-money, cash-secured, put on a pre-vetted, fundamentally strong stock.
Correct. And you collect premium month after month as long as the stock stays up. That generates your baseline income.
But eventually, the market corrects. The stock breaches your strike price, and you are assigned. You take physical delivery of the shares at your predetermined margin of safety price.
Right.
So now I own 100 shares of Microsoft, but my cash is tied up in the stock. If I want to keep generating a yield, I can't sell puts anymore because I use my cash, unless I pivot to the other side of the options chain.
That's the pivot. Because you now physically own the shares, you become the seller of a covered call.
A covered call.
You are now selling someone else the right to buy those specific shares away from you at a higher strike price.
Oh, I see. I'm promising to sell my Microsoft shares at, say, $380, and I collect a second cash premium for making that promise.
Yes.
And that new call premium mathematically stacks on top of the put premium I already collected back when I was waiting to buy it, which aggressively lowers my true overall cost basis even further.
Exactly. You are squeezing premium out of the asset on the way down and squeezing premium out of it on the way back up. You continuously sell those covered calls, lowering your basis until the stock eventually recovers.
And when it does,
It rallies past your call strike, the shares are called away from you by the buyer, you lock in the fundamental profit from the stock appreciation, and your capital is fully released back into cash.
and then you just start all over again by selling a new put.
The wheel keeps turning.
The cash-secured put really is the ultimate tool for monetizing patience. It forces you to adhere to the strictest discipline of value investing, which is buying low while paying you a tangible cash yield to wait out all the market exuberance. You are literally getting paid to enforce your own margin of safety.
It's an incredible mechanism, and it leaves us with a fascinating paradox for the 2026 market, honestly.
What's that?
Think about it. Billions upon billions of dollars are currently being spent on AI infrastructure, complex algorithmic trading, and quantum data centers, all desperately trying to execute trades in microseconds.
Yeah, the speed war.
But what if the ultimate unbeatable alpha isn't speed at all? What if the highest return on Wall Street simply belongs to the investor who has the capital and the patience to sit back and act as the insurance company for everyone else's panic?
That is something to think about. Thank you so much for joining us on this deep dive. We hope it gives you a totally new lens through which to view volatility and value in your own portfolio. We'll catch you on the next one.